Gold is seeing a lot more volatility this week as bond yields have finally started to rise. Joining me today to talk about his macro views and what to look out for is Rob Haworth, Senior Investment Strategist at U.S. Bank Wealth Management. Rob, it's your first time on Kitco. Welcome to the show.
Glad to be here, David. Thank you.
So Rob, we are seeing a lot more volatility in gold this week. What do you make of this price drop that we've seen?
Well, a couple of things. One, we've been pretty overbought for a couple of days now, so I think it's been time for investors to take some profits when they can. And two, what we're seeing in recent times is real yields are finally starting to rise. So that's bond yields, less inflation expectations are starting to rise, which is pressuring gold as well. So I think it's been time for a bit of a correction, and we're getting that now.
So this is a healthy move, is what you're saying?
Yeah, we think it's constructive. I mean, the price of gold has been stretched from our expectations relative to those real yields, relative to inflation expectations, relative to the Fed position, and even relative to the U.S. dollar. And so we're getting it more back in line with what we'd see as a good fundamental price.
And what's the story behind the U.S. dollar and bond yields this week? What's the counterbalance to gold?
Well, on the bond yield side, I think it's the hopes that you're going to get better real growth in this economy. And you had news certainly this morning of hopes for more tax cuts, for more fiscal stimulus coming out of the government, and that's boosting some hope for real growth.
A few months ago, the stock markets were pricing in Fed stimulus, which is why we saw a massive rally in pretty much all the indices. But would you say that much of the stimulus aspect of growth has already been priced in, and now the markets are looking for new reasons to maintain the long positions?
I think probably the best way for us to state it is the market is really priced in what the Fed has currently done. I think the Fed could be tested more, and the onus is probably right now more on the government for fiscal stimulus. We have the sunsetting of the $600 bonus and unemployment claims that sunsetted here at the end of July. And that's going to mean incomes are going to drop off the cliff a bit for a lot of people. So getting more fiscal stimulus would be helpful. I do think, though, that gold prices in particular, but even the market in particular, would be further supported by the continued growth in the Fed balance sheet. We've priced in quite a bit of Fed balance sheet expansion and asset purchases today. As those continue, that probably continues to give the market some room to climb in response to the continued growth in the Fed balance sheet.
Rob, just on the economy, I've heard two extremes on the argument of economic recovery. One, which is that the data has proven that we are still in a rut and we will continue to suffer for months, possibly even years on end. And the other extreme is that we are already seeing near a perfect recovery back to pre-COVID levels. Everyone is already out. Spending on a consumer level has resumed. Shopping is resuming. People are resuming their normal daily lives is basically what I've been told from this side of the story. Where do you stand?
We're probably in the middle. We still see the glass as half full. Yes, we've gotten a good recovery off the bottom, right? The economy has reopened in some sense, and we think we're in the midst of recovery. The challenge for us is the high frequency data has flattened out a bit. So if we look at traveling, whether it's the TSA data, we look at OpenTable, who's dining in restaurants, the improvements are starting to flatten out. And so we're not, in our opinion, yet back to pre-COVID levels of activity overall, nor are we back to pre-COVID levels in employment. So there's more room for improvement and recovery in the days ahead. But we're off the worst levels. And I think that's where the market is looking for that stimulus to help us get back to fully normal, which probably is waiting for a little more for a vaccine or some other medical breakthrough to allow us to fully and safely reopen the full economy and get everyone back to work.
When you look at it, Rob, we're right now in August. It's been less than 2 quarters since we've had the worst of the coronavirus breakout. Is it possible that we have not yet seen the worst of economic fallout? And can we possibly see down the line the real repercussions hit the economy?
Well, in terms of the COVID shutdown, I think we have seen the worst probably in the second quarter data. I mean, the second report of GDP could maybe be worse, right? There's a lot to come through there. That doesn't mean we're out of the woods yet. And so for us, the things we're watching and worrying about are, what are the ramifications on borrowers as we move forward? If we don't get economic activity back far enough, do the debt markets start to shut down again, or perhaps companies move into solvency problems, and we have more of a normal recession that we could enter as we move forward? We're still fairly constructive, right? We still think there's enough room with Federal Reserve stimulus, with further government support for the economy to continue to slowly grind higher in this recovery. But there are downside risks, and it's a meaningful number of downside risks when we're talking about 10.2% unemployment in the month of July.
What are the consequences, if any, of rapid expansions in the Fed balance sheet on economic growth?
Well, in the near term, it's constructive. It's getting inflation up a little higher. It's providing support to the financial system. It's providing confidence in the financial system and to financial asset prices. When we get back to a more normal growth and inflation environment, and that really means more people back to work, there is risk of inflation in that scenario. We think the Fed should be taken seriously, that they're going to reach their inflation target. And so inflation should come back into that 2% range as measured by consumer price inflation or perhaps personal consumption expenditures. But we don't think that there's an inflationary problem down the road. If the Fed stays too long, past kind of this more normal growth environment, we may start talking in time about risks of inflation in the system.
So we're going to see inflation first before possible deflation. Is that what you're saying?
We could see, I think we're going to see a normal reflationary scenario moving from very low inflation to normal inflation. And there's risks of inflation accelerating should the Fed continue to expand its balance sheet in a normal growth environment. But that's some time away. And there are risks of deflation on the other side of this. The challenge we have right now is we have excess supply in a large number of goods and services. Labor is one, but oil would certainly be a close second. And so there are some, I'll hedge this back. I'll say there are some deflationary risks in the near term. We think we're on the side of kind of inflation normalizing back towards the 2% Federal Reserve target. And then there are two-sided risks ahead, depending upon what happens with growth overall.
Rob, do you think that aggregate demand could have recovered even if the Federal Reserve had not expanded its balance sheet this year?
I think the challenge is how we have to combat the coronavirus, which has meant meaningful shutdowns. And so the Fed has been extremely helpful in maintaining the operations of the financial system, but probably hasn't had a huge impact in the end on aggregate demand, which is all about are we able to reopen the economy fully or not?
So what really was the role of quantitative easing on a level that we've never really seen before?
Financial market confidence.
Okay.
One, we've held rates low, so borrowing costs are low. Two, we've made it easier for companies to borrow. There was an example across the tape this morning. You had one of the lowest ever high yield bond issues, lowest yield ever on a high yield bond issue this morning from Ball Corporation at a piece of 10-year paper at less than 3% for a below investment grade issue, which is extremely low. So the Federal Reserve action has really made it so that many companies can get financing at cheap rates, which is helping them stay in business, which is a meaningful support in this economy, which is driven by credit.
Could capital markets see a liquidity trap as we saw post 2008 when there was a lot of liquidity in the system, but nobody was lending or borrowing immediately after?
We've already gotten past that.
Okay.
That really was happening in March. We think we've moved past that for now with the Fed providing ample stimulus in the system and ample liquidity to the system. And we've even seen some of those short-term measures move out of their balance sheet. So a couple of weeks ago, we were seeing a dip in the Federal Reserve balance sheet, which was the runoff in the repos they'd accumulated. And now the balance sheet is growing again as they continue to buy mortgage-backed securities and treasury bonds.
What's your sentiment on current U.S. equities valuations right now?
They're on the full side, but with where the Fed is, we think there's room for them to run. We're comfortable that with we're still in a low inflation environment. Even if the Fed gets back to more normal inflation rates, we're still in a low inflation environment. There's room for earnings to recover and grow, and we're seeing earnings expectations start to climb for third and fourth quarter earnings. And the fundamental picture, the technical picture looks pretty good. So we think there's still room for stocks to perform even with valuations at fairly fully valued levels.
Okay, so you're constructive on the equities for now.
We are.
So, Rob, why is it necessary for the Fed to maintain their stimulus measures even if, like you mentioned before, the economy is on the right track to recovery, albeit rather slowly?
Because it'll take time. We're not yet out of the woods, and so the Federal Reserve needs to continue to provide that backstop as they even think about their dual mandate. Right, one of the elements in their mandate is a level of full employment, and we're not yet at their inflation target, and we're kind of well above normal rates of unemployment. So I think they've got more work to do.
How would you personally allocate your assets right now in your portfolio? Where are you underweight? Where are you overweight?
Yeah, it is a challenging time for investors as we look at the performance in the stock market. That said, we'd say you today should be fairly normally allocated between stocks and bonds. So whatever your long-term target is, you should probably stick to that long-term target for now until we get through this recovery scenario and probably into a more growth-oriented scenario. On the fixed income side, it's worth taking some risk in credit. As the Federal Reserve has provided the backstop to bonds, we've seen credit spreads, meaning the yield on lower quality investments has compressed somewhat relative to higher quality investments relative to U.S. Treasuries. We think that continues, so that's a place to take some additional risk in portfolios relative to your fixed income portfolio. On the equity side, we tilt towards growth-oriented companies. Secular growth is still in short supply in this economy. And so those stories will probably continue to do well as we move forward. And the place we're probably least enamored of right now is developed international, so Europe and Japan. We'd underweight those economies in order to fund that overweight to secular growth.
Just on the credit side of your story, are you at all concerned about the potential for more bankruptcies across corporate America that could push credit ratings down?
Yes, absolutely. There are certainly companies that are under stress or under distress, and this is where active managers are probably really important to help you steer clear of some of those pitfalls and problems. And so that's what we use within our portfolios as active managers. That said, we still think the overall trend, right, kind of across the entire market is going to be for those spreads to remain relatively tight. And a lot of that has to do with Fed support. The Federal Reserve out there buying corporate bonds directly is going to continue to provide support to that market, especially for those that by and large won't have distress or default problems.
Just going back to the equity side of your portfolio, you mentioned earlier that you're still constructive on stocks. If that were the case, would you not err to the side of being more aggressive than an equal allocation of bonds and equities?
Yeah, no, that's a great question. It's something we continue to think about. I think the challenge for us is it's really still a two-sided. There's a two-sided scenario as we look forward, and there's an awful lot of risks to get through in the meantime. One, we don't yet have fiscal stimulus decided upon, and Congress and the White House continue to be somewhat at odds. Two, we need to get through the back-to-school season. And that's a large question for many families and will have an impact on employment and whether people come back into the labor force as we get back to school, if we get back to school. I know for me here in Seattle, for example, the kids are going to virtual learning, which is going to create a challenge, and we need to make those decisions across the economy. And then the third two-sided risk for us is actually the election. Right now, we have Vice President Biden in the lead in certain polls. We need to probably get more clarity before the market really starts to face the uncertainty of this next presidential election. And so there are, in our minds, still two-sided risks in this environment as we move forward, both largely to the upside and the downside. So we've erred on the side of a little bit of more balanced risk in our portfolios rather than getting more aggressive on one side or the other.
In your view, is there a political outcome that would be more negative for equities prices?
We don't really see that yet. We need to see a lot more on policies. Some of the indications we've seen, there were early expectations that if there was a Democratic wave, it would be very challenging for the market. Some of the initial policies we've seen have been much more moderate than I think the street had originally expected. So we need to see a little more to really have a good handle on what the market may do.
How does gold fit into your thesis for portfolio allocation?
Yeah, gold's getting attractive for us at this point, especially with this decline. And the primary purpose of it would be to provide some downside protection relative to our equity position. The challenge for most investors right now is you're getting paid very little to own 10-year U.S. Treasuries today at 0.64%. You're just not getting paid much to own those, so that makes gold somewhat more attractive as a defensive asset in portfolios, and that's how we're thinking about it.
So Rob, has gold always been an asset that's been on your radar, or was it something that you've paid attention to only in recent months as prices rallied?
Yeah, we haven't always had an allocation in our portfolios, but it's something that we do analyze on a daily, weekly basis because of that characteristic. I think that the challenge for investors in gold is there's no cash flow to compensate you for holding it over time. So you very much need prices to continue to go higher to be compensated for holding that asset. So we've used it more as a tactical asset than a strategic, permanently held asset. And in this environment, it's becoming more attractive to us.
Rob, I want to thank you for your time today and for sharing your thoughts. Appreciate it.
Thank you very much, David. It was good to be here.
I'm David Lynn of Kitco News. Thanks for watching. We'll have more for you, so stay tuned.